Welcome Jennam Sarena. In this video, let us discuss about the different types of mutual funds. A mutual fund is an investment vehicle for the investors who pool their savings for investing in portfolio of securities for earning attractive yields and appreciation in the value of investment. The mutual funds can be classified into five broad categories as mutual funds according to ownership, according to scheme of operation, according to location, according to portfolio, and other mutual funds. Now, let us discuss each one of these in detail. And first of all, according to ownership, we can classify the mutual funds into two as public sector mutual funds and private sector mutual funds. The public sector mutual funds are sponsored by public sector companies. For example, SBI Mutual Fund, Can Bank Mutual Fund, etc. And the private sector mutual funds are sponsored by private sector companies. For example, ICICI Mutual Fund, Reliance Mutual Fund, etc. The most important classification of mutual funds is on the basis of scheme of their operations. According to this classification, they are categorized as open-ended funds, closed-ended funds, and interval funds. First of all, let us discuss about the open-ended fund or open-ended scheme. That means a scheme of mutual funds that offers units for sale without specifying any duration for the redemption. These schemes do not have a fixed maturity, and the entry to the fund is always open to the investors who can subscribe it at any time. In the same way, the investors have an option to get their holdings redeemed at any time. So, investors can purchase units at any time, and similarly, they can also redeem their units at any time. The fund redeems or repurchases the units or shares at periodically announced rates. These repurchases are based upon the net current asset value of the fund. Hence, we can say that the open-ended funds provide better liquidity to the investors. And in the same manner, the price at which the units are offered to the public is also announced periodically. So, it is totally transparent. As an investor can directly purchase and sell the units under the open-ended schemes, these are not listed in the stock exchanges. Anybody can purchase or sell units under the scheme. And coming to the closed-ended funds, it means a scheme of mutual fund in which period of maturity of the scheme is specified or fixed. Unlike the open-ended funds, the closed-ended scheme is fixed and an investor can subscribe directly to the scheme only at the time of initial issue. We have already seen that the open-ended funds are open to the subscribers at any time, but closed-ended funds are not open always. It closes after a particular period of time, and people can subscribe to the units only until that closing time. After the initial issue is closed, then a person, if he want to buy the units of the scheme, he can buy or sell the units in the secondary market. That is the stock exchanges where these are listed. And the price in the secondary market is determined on the basis of demand and supply. Hence, it could be different from the net asset value. It is always easier to manage a close-ended scheme because The fund managers can evolve long-term investment strategies depending upon the life of the scheme. So that's all about the close-ended funds. And the next one is an interval fund. It is a scheme of mutual fund which is kept open for a specific interval. After that, it operates just as a closed scheme. Thus, we can say that it combines the features of both open-ended scheme as well as closed-ended scheme. And the interval scheme is open for sale or repurchase at fixed predetermined intervals. So, this period is fixed and it is predetermined. So it is disclosed to the investors in the offer document. Since it is predetermined and fixed, it can be disclosed to the investors, and that is done in the offer document. The units of the scheme are also traded in the stock exchanges. The mutual funds can be classified according to portfolio as money market mutual funds, taxation funds, leveraged funds, specialized funds, bond funds, equity funds, balanced funds, growth funds, and income funds. And now let us discuss each one of these in detail. Let us take income funds. These funds aim at providing maximum return or maximum income to the investors. That is the specialty of income fund. It invests in stocks yielding higher returns, and capital appreciation is of small importance. Their main aim is to bring maximum income to the investors. Such funds distribute the income earned by them periodically among the investors because the investors are interested in earning income. So they distribute their income earned among the investors periodically. There may be two types of income funds as constant returns with low risk and maximum returns with risk. Some funds may concentrate on low risk and constant returns, while other funds aim at maximum return even at the cost of some risk. So that's all about income fund. And now coming to the growth fund, these are the funds aiming at providing capital appreciation in the value of investment. Such funds, they are not aiming at higher returns. Their aim is capital appreciation in the value of investment. That is the speciality of growth funds. So their investments will be like that. These funds invest in growth-oriented securities that have got a potential to appreciate in the long run. Growth funds concentrate on value appreciation of securities and hence the risk is higher. They do not concentrate on the regularity of income. And so the growth funds are also called as next eggs investment or long haul investment. However, the risk involved in such funds are higher than the income funds. And coming to the next type of fund, that is balanced fund, its main aim is both capital appreciation and regular return. We have seen that income funds focus on regular return and does not give much importance to capital appreciation, while growth funds give importance to capital appreciation and they give least importance to the regular return. Here, in the case of balanced funds, they focus both on capital appreciation as well as regular return. So, balanced funds spend both on common stock and preferred stock. Some part of the fund is spent on buying equity, while the other part is used in acquiring interest-bearing debentures and also preference shares ensuring certain amount of dividend. The balanced funds thus ensure both appreciation in stock as well as regular return in the form of interest and dividend. Thus, investors have the advantage of regular income and appreciation in the value of securities. And these funds are also called as conservative funds or income and growth funds. And the next type of fund under this classification is the equity fund or the stock fund. They undertake risk associated with investment in equity shares of companies. So, we can understand that they mainly invest in the shares of companies. The investments may vary from blue chip companies to the newly established companies. And a special type of equity fund is called index fund or never beat market fund. And the stock funds may have further subdivisions such as income funds and growth funds. And the next one is a bond fund. These investments ensure fixed and regular income. That is why these funds employ their resources in bonds. The shareholder is saved of the botheration of buying bonds compulsorily. The bond fund will pay less than the face value of the bond, thus saving money. The bond funds ensure regular income to the investors. That is the peculiarity of a bond fund. It ensures fixed and regular income to the investors. So, those investors who are interested in it, then they can purchase units of bond funds. And then comes the specialized fund. This fund specialized in the securities of companies dealing in a particular product. Thus, we can say that these funds invest in a particular type of security. They invest in firms that are in a particular industry or of a certain income producing securities. They invest in a special category. Any investor wanting to invest in a particular security will prefer a fund dealing in such securities. So these funds specialize in certain area. If an investor is interested in a specific area, that investor can invest in that particular fund. And the next type of fund is a leverage fund. The primary aim of a leverage fund is to maximize capital appreciation. So, these funds they may use even borrowed funds for buying speculative stock which ensures a profit in the future. And the leverage is used to the benefit of the shareholders. They indulge in speculative activities to earn more and more profit. And in a declining market, the fund may indulge in short sales. The reduced price of the stock in future will benefit the fund. Some other methods may also be used to ensure higher profits. That is what is called a leverage fund. The next one is a taxation fund. The mutual funds have designed a taxation fund to suit the taxpayers. The amount collected by these funds is used to acquire shares and interest bearing securities. And the contributors to such funds get some concession in income tax. And these funds distribute the profits among the unit holders. A repurchase offer of units is also given at the current net asset value. A large number of mutual funds have come up with schemes which ensure tax benefits to the subscribers besides some income and a small appreciation in the value of units. The net asset value of the units varies with the value of the securities held. Generally, the income tax payers contribute in these funds. And the last type of fund under this classification is a money market mutual fund. It is a fund that is set up with the aim of investing exclusively in money market instruments. These instruments include treasury bills, dated government securities, call and notice money, commercial paper, commercial bills accepted by banks, certificate of deposits, etc. We know that the capital market mutual funds deal with equities and bonds or debentures, but the money market instruments constitute the only portfolio of the money market mutual funds. And then, according to the location, the mutual fund can be classified into domestic funds and offshore funds. First of all, let us see what is a domestic fund. These are the funds that mobilize savings of people within the country where the investment is made. Domestic funds can be further classified on the basis of other classifications that we have already discussed, like the scheme of operation or portfolio, etc. The offshore funds are those which raise or mobilize funds in countries other than where investments are to be made. These funds attract foreign savings for investing in a country. So, these are the different types of mutual funds. Thank you for watching this video. For more videos, subscribe the channel.